The Reserve Bank of Australia cuts, with further easing on the cards. US inflation lifts, but with good signs, tariffs are only having a transitory effect, and New Zealand's economy may be showing signs of life. That's coming up in our 5 Things in 5 Minutes on Wednesday, August the 13th. And then in our deep dive interview, ANZ Head of Australian Economics Adam Boyton reviews the RBA's decision and its latest set of forecasts.
The board is clearly got a bit more comfort that inflation is going to get back to the midpoint of the target band and stay there.
But first, in 5 and 5 with ANZ, US markets reacted positively overnight to a July inflation report that showed core CPI up 0.3% in the month and an annual rate of 3.1% in June. That was up from 2.9% in May. ANZ Head of G3 Economics, Brian Martin, says the lift was driven by services prices, indicating the impact of tariffs on goods prices is transitory, paving the way for Fed rate cuts.
Yes, the annual rate of inflation has ticked up, but one that I don't think is really showing signs of inflation persistence. And on that basis, I think with monetary policy still being moderately restrictive and with demand in the economy having slowed, I do think that what we're experiencing now is an inflation hump rather than a persistent inflation rise. Our forecasts are that inflation will come back down. And with the labour market weakening, we think that the conditions for the FOMC to cut interest rates 25 basis points in September are falling into place.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 1%, with the Nasdaq up 1.25% after that inflation data. The US 10-year Treasury yield was up 1 basis point to 4.29%. Gold down 0.2% at $3,399 an ounce. West Texas oil futures down 1.1% to $63.24 a barrel. The US dollar index fell 0.5%, with the Aussie dollar overnight up 0.3% at 65.30 US cents. And the Kiwi also up 0.3% at 59.54 US cents. Number 2, the Reserve Bank of Australia yesterday cut the cash rate 25 basis points to 3.60%. ANZ Head of Australian Economics, Adam Boyton, says the move and the motives were widely expected.
The reasoning sitting behind that decision to cut the cash rate, I don't think would have surprised people too much. The post-meeting statement noting that with underlying inflation continuing to decline toward the midpoint of the target range, labour market conditions easing slightly, that a further easing in monetary policy was judged by the board to be appropriate. So no surprises in the rationale and no surprises this month, at least, in the decision from the RBA board.
And we'll have more from Adam on the RBA decision in today's deep dive. Number 3, ahead of the RBA cut, the ANZ Roy Morgan Australian Consumer Confidence Survey showed a slight dip last week to 89.3. ANZ senior economist Adelaide Timbrell says people's confidence about their own finances dropped slightly.
On a kind of month-to-month basis, we're still stronger and people are feeling more confident about the economy over the next 12 months. When we look at the monthly average of the data, it's actually at a 3-year high. So even though there was a small weekly dip, we are still, I would say, in the uptrend of confidence. And the Reserve Bank moving the cash rate down in their August meeting is likely to be a boost for confidence from here.
Number 4, Adelaide says yesterday's rate cut will likely boost people's confidence in their own future financial conditions.
They look over the next 12 months and expect to be better off, particularly if they perhaps have a mortgage and know that they'll be paying less interest. And it can be a positive signal for the future of the economy as well. That's not always the case. You know, if the Reserve Bank suddenly cut 50 or 100 basis points, it might sound a bit like an emergency and push those economic conditions downwards. So it all depends on the context, but overall, nothing in the commentary would be cause for alarm, and that 25 basis point cut is likely to be very welcome for the average consumer in Australia.
Number 5, ANZ New Zealand's Trachometer Index for July showed both light and heavy traffic movements rising in the first month of the third quarter. ANZ New Zealand Chief Economist Sharon Zollner says that's an encouraging sign.
The April, May, June quarter was really quite soft. And indeed, we saw that in the heavy traffic data as well. It actually fell 0.1. So basically went nowhere in that quarter. So the big question now is the economy back on the way up again? And in July, it was good to see the heavy traffic index lift 1.8%. It is up 2.8% year on year. So that's a reasonably good number. Of course, a year ago, we were in recession. So you always need to bear the starting point in mind. But it's an encouraging start. It's just 1 month. The data can be volatile, but on the face of it, Q3 is off to a better start.
Sharon Zollner there. Now, in our deep dive interview, ANZ Head of Australian Economics, Adam Boyton, analyses the RBA's revised forecasts released yesterday. He's talking to my colleague Alex Tarrant, firstly, about the RBA's underlying cash rate assumption that underpins its outlook.
The underlying cash rate assumption is just that. And what I mean by that is the bank needs to, when it's putting its forecast together, come up with an assumption for where interest rates go. And a long time ago, they used to assume the cash rate was unchanged. Then they based that assumption on surveys of economists and market pricing. And now we've moved to a cash rate assumption that's based on market pricing. And what that assumption says is cash rate will be a little below 3% at the end of next year and a little above 3% at the end of 2027. The way the governor characterised it in her press conference yesterday was that it had a couple more cuts in it. I think the market does tend to get quite focused on this assumption. And what I'd say is, for the Reserve Bank's forecasts, whether you have one or two cash rate cuts probably doesn't drive the forecast quite as much as the market might sometimes think.
Obviously, the RBA keeps a close eye on both inflation but also labour market strength. What were the RBA's views on those two key data points?
On inflation, I think the board is clearly got a bit more comfort that inflation is going to get back to the midpoint of the target band and stay there. Of course, year on year, trimmed mean inflation running at 2.7%, so close to the band, and the RBA staff forecasts for it to then decline to 2.6 all the way through until the end of 2027, where it nudges down to 2.5, so the midpoint of the band. No huge surprises there in those forecasts. On the unemployment rate, no changes relative to where we were in May. The RBA has the unemployment rate at 4.3 across its forecast horizon. It did, or the board in the post-meeting statement did make the point that the labour market was a little tight. The use of the word little there is new. Previously, they described the labour market as tight, and they added that it had eased a bit over the past couple of months, which would be a reflection and picking up that increase in the unemployment rate to 4.3% that we got in the June labour force data.
Looking more broadly at the wider set of forecasts they presented, any changes there since May that were of note?
The most interesting one was probably the RBA revising down its assumption for trend productivity growth. Again, in the forecast, they need an assumption for productivity growth. The governor was quite clear in the press conference that they don't necessarily model that. They're more needing an assumption to include in the forecast. So what they've done is revised that assumption down from a previous 1% productivity growth at the end of the forecast horizon to 0.7 now, that 0.7 being the 20-year average. The consequence of that is it means that potential GDP growth over the RBA's forecast horizon is a little lower, so it's now 2%, not 2.25%. That doesn't have any implications for inflation or interest rates because the Reserve Bank are essentially assuming both demand and supply in the economy have been reduced by about the same amount.
And then obviously since May, and I guess still now, there's a lot of global uncertainty out there. How has the bank's views on the global situation evolved since May?
The biggest change since May is that the more extreme downside scenarios or risks seem less likely to materialise. Having said that, the bank still would view downside risks to the outlook from a global perspective.
And then just in terms of your views on where the cash rate could be headed over this year and into next year, any changes there?
We've got one more cash rate cut in our forecast with a rate cut in November.
Adam Boyton there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, August the 13th. Catch you tomorrow with how Australian wages performed in the second quarter. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.